Hello everyone and welcome back to our channel once again. As of November 2022, today's news highlight was that on a sixth consecutive level, the Federal Reserve is expected to hike its key interest rate by another 0.75%. So what does the Fed rate hike mean for commoners like me and you? So let's go into the details. The higher Fed rates means more expensive borrowing costs, which can reduce the demand among banks and other financial institutions to borrow money. The bank passes on these high borrowing costs by raising the rates they charge for the consumer loans. The Federal Reserve, which serves as the US central bank, is working to get the inflation under control. To do this, the Federal Reserve raises the rates. This is meant to encourage saving and reduce consumer spending, which in turn should decrease the demand. While raising rates can help the Fed address inflation, it can impact financial options, including mortgages. COVID-19 created a lot of issues, from supply chain disruptions and staffing issues to surging production cost and high demand of products and services due to financial help from the government. All of these have a role to play in the dramatic rise in inflation. And now, with Russia's invasion of Ukraine and the resulting sanctions, oil prices have skyrocketed, contributing more to inflation, which is now at a 40-year high. As in American history, when inflation is high, the rates always go up. And so, Fed has and will continue to raise the rates in 2020. The Fed rates have a direct impact over your mortgage rates. Now, let's understand how the Fed rate hikes affects you as a home buyer. The rising Fed interest rate have a major effect on home buyers. High rates means you pay more interest, which will reduce your buying power because you won't be able to borrow as much money. That's because less money will be going towards your principal and more money will be going towards your interest. Let's take an example. The monthly mortgage payment for a 30-year mortgage for a $200K loan at 6% is $1,199. If the interest rates were 3%, you could have afforded to buy a $285,000 home loan for the same monthly payment. Just keep in mind that this doesn't include the property taxes and insurances. These are just example for our easy calculations and references. There could be a benefit for home buyer who have been dealing with high home prices and an extremely competitive market. Higher interest rates could help reduce the demand that's currently driving up the home prices. If you are a home buyer, keep an eye out on the local market and consider locking your rate when you are ready to move forward. And always, in a matter of time, in months or in the coming years, the rates have to come down and you can always choose to refinance your home at that. Remember that just because you qualify for a certain amount doesn't mean that you should borrow that maximum. Take the time to work through how much you can afford, including your monthly payments. Work with your lender to get an estimate of what your monthly mortgage payment could be, with different loans and with different interest rates and different programs. Now let's move on to from a perspective of a home seller. How does the Fed rate hike affects the home seller? Because it may be more expensive to get a home mortgage, buyers may decide to wait. So when the Fed rate hike could make a home harder to sell, many people still need to buy a home. Buyers have been struggling to find home for a long time and that might still be eager to buy. However, if it costs more to borrow money and that pairs with a decrease in housing demand, you may not get the astronomical offers that you were hoping for that other sellers have seen earlier this year. Now let's look at the perspective of refinance plans. How the Fed rate hike could affect your refinance plans. Mortgage refinancing works by essentially paying off your current mortgage with a new mortgage, basically trading in old for the new, which may come with a new interest rate, term or a loan amount. If the interest rate on your mortgage is lower than current rate, you may end up getting a higher interest rate when you refinance and your monthly payments may go up. However, people have different reasons to refinance. Some refinance to use some of the equity in their homes, while others refinance to change their interest rate, or some refinance to change the length of their loan. When the rates dropped to the historical lows in 2020 and 2021, many people refinance their loans to a lower interest rate. While rates are higher now, some people may still be able to benefit from a refinance. If the rate is higher than today's mortgage rates, now could be the time to refinance to a lower rate. And since the home values have recently skyrocketed, homeowners may have more equity in their home at this moment, which means they may be able to take more cash out So if you have equity in your home and was wondering if it's the right move to make, use a cash out refinance calculator and see how it can help. Hope you found this video helpful. If so, share your comments. Once again, thank you and stay tuned.